Welcome back to another episode of Investing Explained. Here's today's question. I think we're all looking at the stock market and the economy and wonder what's going on right now. Now, the first thing to understand is that the stock market is not the economy. It rhymes, but it's not the same thing. So let's first talk about what the economy is. The economy is the sum of all goods and services that Americans in aggregate produce. And before COVID-19, the economy was around $22 trillion annually in the US. And so everything else equal, when you have high unemployment, it won't be good for the economy. For the simple reason that unemployed people don't produce as many goods and services as employed people does. So everything else equal, you're absolutely right when you don't understand why the stock market should be going up when the economy is going down. But let's talk about what the stock market is. The stock market is the value investors put on the earnings of listed US businesses. That's also why the Shiller PE that we talked about a bunch of times here on the show is such a popular metric, because it measures what price all investors put on the inflation-adjusted earnings over the past 10 years. And implicitly, in this number is also the opportunity cost of other assets and the growth potential of US equities. If the Shiller PE is high, it means that other asset classes are less attractive. It could also mean that the growth potential for US equities is really high, or it could downright mean that the stock market is overvalued, and typically it is a combination of the three. But going back to the original question, it's really important to understand that the US stock market is not the same as the US economy. Let me give you an example. So, Apple has more workers abroad than in the US. Apple also has more revenue international than in the US. However, Apple is still considered US stock. But in theory, even if the US went into a slump with declining revenue and declining margins for Apple as a result of that, the market would still rationally value the Apple stock higher if the international business more than offset that. And that would in turn result in the US stock market being priced higher. So while I just used Apple as a generic example, I hope that it really showed why the economy and the stock market is not the same thing. And there are many other reasons why the stock market has just recently raised the 2020 loss. One reason is that the economy is generally backward-looking, whereas the stock market is forward-looking. So when you hear the latest unemployment numbers and GDP numbers, it's something that has already happened. The stock market is trying to price in what's going to happen, and what's going to happen to the discounted cash flows of the remaining of the lifetimes of US equities. Now, the stock market does get indication of what's happening at the present, but in nature, it's forward-looking. And then you also have the Fed manipulating the market big time. So whenever you have an enormous buyer of bonds in the market that has pledged more than $2.6 trillion, and just so far, who knows what's going to happen in the future, it presses down the yields of bonds, which makes stocks in comparison more attractive because the opportunity cost of holding bonds changes. And that forces the stock market to go up. Now, giving credit when credit is due, Preston mentioned this already when the market was tanking back in March. And this was when everyone was talking about the 1929 stock market dropping 85% from its all-time high. And Preston talked about how dependent the stock market is on the printing of the Fed. And given that, he wouldn't be surprised if the stock market hit all-time highs. So I think it was really interesting call that he made back in March. But if I can even add to that based on my point earlier, it's the expectation to the future more than what has happened already. And they have even been very local about printing as much as required. We know from earlier crises, 2008, but also other crises, that the Fed can talk the market up and down just as effectively as actual printing money and buying securities. And that is what you see playing out right now.
My comment might sound more cynical, and the thing that I think a lot of people are misunderstanding about the markets today is they're assuming that they're free and open. And I think that's a bad assumption. I think that what you have playing out right now is just an unprecedented amount of manipulation happening in the market. And so that's first of all why it doesn't feel normal or feel right that you're seeing the things that you're seeing. I don't know what the real unemployment number is, but let's just say the number's between 15 and 20%. How can you have those kind of numbers and the stock market making runs at all-time highs? And the only way that I can personally come up with how that's possible is that there is intervention, there is manipulation happening in the market. So let me just give you an example. The Fed balance sheet, before all of this went down in the February-March timeframe, was hovering, let's just say, close to $4 trillion. Just a hair more than that. But for simplicity, we'll just say $4 trillion. Today, it is now at $7 trillion. They printed that much money. They almost effectively doubled the size of the Fed balance sheet in a matter of 3 months. So when you think of it like, and I know shares are not a fixed supply, but they're much more of a fixed supply than some other things that are going on right now. So I think you could, if you want to say it's similar to gold, I guess you can try to make that argument. It's obviously not, as far as the supply base and how much you can actually increase the supply of the shares outstanding if you were looking at the market as a whole. But let's just say that that's somewhat pegged or fixed. What I think you're finding is that a lot of people in the market are looking at equities more as a form of sound money than they are looking at the earnings or the actual performance of the underlying security. And so when you're looking at something that has somewhat of a fixed peg to it, the equity, the number of shares outstanding, and you're comparing that to the money supply that went from 4 trillion to 7 trillion in a matter of 3 months, people do not want to be sitting there on the sidelines holding fiat cash when you literally had a tsunami flood of fiat that was added into the system. Now, what this is all, in my personal opinion, what this is all coming down to globally is the dollar. And you have so much dollar denominated debt all around the world. And what's happening is they print, as the Fed steps in and they print more and more and more, and they add this into the system. What's not happening is the money's not making itself down into the general population. Where that money is going is it's going straight into the market capitalization of securities, primarily in the bonds. And so that's why your bond yields just keep getting pushed lower and lower and lower all around the world. So all these countries that have dollar denominated debt, they need that servicing. They need more liquidity added into the system in order to keep the solvency of all these securities in check. But the problem is as the Fed keeps adding more and more liquidity into the system, it's going to servicing that, and it's going into bidding the market capitalization of those, opposed to actually trickling down into the economy where people actually need this money in order to, and if you check out the velocity of money, that's why the chart has been going down for year after year. So how do you look at this as an investor? I think is where you're really getting at it. And as an investor, I think that if you're heavily relying on valuation metrics, which is Stig and I's bread and butter, you might find yourself in a tricky situation, because so much of what's happening in these big violent moves are based off of dollar liquidity in the system, and it drying up and then them replenishing it, and then it drying up and then them replenishing it. And so if you're trying to do when you're doing valuations and you're doing these Buffett style valuations, you're making an underlying assumption. And that underlying assumption is that you're dealing with sound money, and you're dealing with a real cost of capital and economic calculation that's occurring in the economy. My argument is today you're not seeing that because all these interest rates are pegged to nothing percent. And if they're pegged to nothing percent, you don't have a cost of capital and you can't do economic calculation for the valuation of things. So this is where I think becoming, or at least having more of a momentum style of investing in your approach can help significantly, because it really takes a lot of the valuation piece out of it. And it's just looking at the pure statistics of the price action. And it's saying, hey, historically, this volatility is uncharacteristic. Therefore, it's going up. Or this move based on the price action is uncharacteristic to the downside. Therefore, I need to sell it. And so the calls that our TIP Finance have been making for the S&P 500, for the NASDAQ, have been exemplary, because it's heavily reliant on just the price action, and it's looking at the statistical volatility and basically giving you a thumbs up or a thumbs down, whether it's within trend or out of trend. So I really think that moving forward, that's going to be a really powerful tool for people, because so much of what's happening, how can you come up with a valuation when interest rates are at 0%? Because every central bank in the world is manipulating their economy in order to have enough liquidity to service all this dollar-denominated debt and all these issues that we're now seeing playing out real time. So I think that as we move forward, I think you're going to see more violent whiplash like we have seen since the start of 2020. If we saw another leg down as deep as what we saw before, and maybe even deeper, that would not surprise me in the least bit. If we made all-time highs, that would not surprise me in the least bit. And I know that doesn't sound like that helps anybody, but I guess what I'm really getting at is your expectation moving forward should be that we are going to experience extreme volatility. The reason why I think you're going to continue to see extreme volatility is because we're in a major currency crisis. And as you have so much credit in the system, it contracts and expands as they're adding more, and the contraction is happening because of all the issues that you have on the balance sheets for all these companies, and the impairment that you're having on the balance sheets, and also in the derivatives market. As you get into the supply and demand adjustments that are happening based on the expectation of the demand for oil. Now all of a sudden COVID-19 is going away, or people are saying it's going away. So then all those derivatives get repriced. Well, guess what all those derivatives are denominated in? They're denominated in dollars. So there's this surge for dollars as all this supply and demand contraction and expansion is occurring. So all those things are making this an extremely difficult time to navigate. So I would tell you to focus a lot on a momentum strategy. And if you can back it up with valuation metrics, I think that that's probably going to be the best approach moving forward.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.